Ladies and gentlemen, good day and welcome to Krishca Staffing Solutions Limited H2 FY'24 results conference call hosted by Kirin Advisors. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Vaishnavi Ambokar from Kirin Advisors. Thank you, and over to you, Ms. Ambokar.
Thank you, Michelle. Thank you. On behalf of Kirin Advisor, I welcome you all to the conference call of Krishca Staffing Solutions Limited. From management team, we have Mr. Balamanikandan, Chairman and Managing Director, Mr. Perili Venkata Shivaji, Whole-Time Director, and Ms. Dia, Company Secretary. Now I hand over the call to Ms. Dia. Over to you, ma'am.
Thank you, Ms. Vaishnavi. Good afternoon, everyone. Thank you for joining us today for the Krishca Staffing Solutions Limited earnings conference call for the second half of financial year 24. We are delighted to share our financial results and highlight some significant developments that underscore the strength and growth trajectory of our company. Krishca Staffing Solutions Limited, founded in December 2017 and headquartered in Chennai. Our company was swiftly emerged as a leading total packaging solutions provider in the steel industry. We are proud to be the leading manufacturer and exporter of high tensile steel strapping and allied packaging products, known particularly for our eco-friendly production processes. We serve over 200 customers and employs a staff of over 100 individuals. Our commitment to sustainability is exemplified by our distinction as India's first and only lead-free and eco-friendly production line for heat-treated steel strapping, leveraging cutting-edge technology. We have achieved significant cost reductions compared to industry standards through minimized scrap generation, energy-efficient production processes, and a reduced environmental footprint. Our integrated steel strapping manufacturing facility in Tamil Nadu boasts an annual capacity of 30,000 metric ton of steel straps and 120 million strapping steels. This state-of-the-art facility, staffed by highly skilled personnel, consistently delivers top-quality products to our customers. Our diverse product profile includes steel straps, steel seals, HDPE, and LDPE, primary packaging products, tarpaulin, dunnage airbags, hot straps, lashing belts, and desiccants. We are continuously working to increase our capabilities and diversify our product portfolio. In the second half of financial year 24, we achieved several milestones, including securing a job contract from the Steel Authority of India, effective until October 2025, with an initial contract value of 2.48 crores. We received an order from Salem unit in Tamil Nadu, valued at 67.25 lakhs to supply packaging materials, valid until October 2024. We also secured a significant packaging contract from Vedanta Limited, valued at 20.25 crores for securing fastening and covering services for trucks and containers transporting finished goods. We have also secured 1.39 crores worth order for supply of steel strapping to Rashtriya Ispat Nigam Limited, Visakhapatnam Steel Plant, Central Government Public Sector Undertaking. As of March 2024, our order book stands at 28.280 crores, comprising 1.39 crore from strapping contracts and 27.40 crores from packaging contracts. We are also delighted to share that our company, in its ongoing efforts to boost operational efficiency and to expand production capacity, has successfully commissioned our new strapping line. This state-of-the-art eco-friendly facility began its commercial operations on 13th May 2024. Launch of this line represents a crucial step forward in our strategic growth plans, poised to significantly bolster our manufacturing capabilities. Our strategies of expanding production capacity for ultra-high tensile, high-margin products and strengthening our position in packaging contracts will significantly bolster our financial performance in the near future. We are committed to capturing a substantial share of the domestic market while simultaneously expanding our footprint in the export market. Looking ahead, we plan to set up operations in the Middle East, and we are very actively exploring to set up our operations in Middle East. We are continuously striving to participate in more contracts and establish a stronger market presence. Now let's dive into financial highlights for second half of financial year 24. We have achieved a total income of 56.80 crores, marking a half-on-half growth of 16.18%. Our EBITDA reached 11.89 crores, showing an impressive growth of 42.25% with an EBITDA margin of 20.94%, an increase of 384 basis points. Our PAT for this period stood at 7.56 crores, representing a growth of 33.25% with a PAT margin of 13.32%, up by 170 basis points. Additionally, our EPS for H2 financial year 24 was 6.33, reflecting a growth of 23.39%. For the full fiscal year 2024, we are thrilled to report that we surpassed the 100 crore milestone in revenues with a total income of rupees 105.68 crores, reflecting a year-on-year growth of 45.95%. Our EBITDA for the year was 20.26 crores, a growth of 46.02% with an EBITDA margin of 19.17%. Our PAT for the financial year 24 was 13.24 crores, showing a year-on-year growth of 41.73% with a PAT margin of 12.53%. Our EPS for the year was 11.46, reflecting a year-on-year growth of 7.30%. In financial year 24, we experienced significant growth across key metrics. Domestic sales remained strong at 88.52 crores, while export sales contributed 16.50 crores compared to previous year exports amounted to 5.76 crores, reflecting a growth of 287%. These financial results underscore our robust performance and the success of our strategic initiatives. We are confident in our ability to continue this momentum and deliver strong results in the future. Going forward, we aim to increase our packaging contract revenue to more than 50% in coming years. We are optimistic about future growth opportunities and confident in our ability to optimize profit. We expect significant growth in both domestic and global markets, particularly in the packaging contract division. Our goal is to capture a 30 to 40% of market share in the steel strapping industry, with packing contracts expected to contribute more than 50% of our revenue in the future. With expanded production capabilities, new product diversification, regional expansion, and the introduction of various new products, we are well positioned to seize numerous opportunities present in the market. We are confident in our ability to continue on this growth trajectory. I would like to reiterate that the future holds promising opportunities for our company, and we are committed to maximizing profits from these opportunities. We deeply appreciate your trust in Krishca Strapping Solutions and your integral role in our journey. With this brief update, I would like to hand over the call to our Chairman and Managing Director and request the operator to kindly open the floor for the Q&A session. Thank you.
Thank you very much, ma'am. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and one on their touchtone phone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Hiral Nandu from Kalpavruksha Capital. Please go ahead.
Congratulations for the great set of numbers, Mr. Bala.
Hi, very good morning. Thank you very much.
Good morning. Yeah. Couple of questions and some points if I missed, want to reconfirm. Current order book is 28.8 crores, right?
Yes, that's right.
And it has a Vedanta contract of 20.5 crores, right?
20.25 crores, that's right.
Okay. So definitely means this would be around couple of months and further we would be expecting more order book for the year, right?
Yeah, absolutely. Because we just started this packing contract division.
Right.
Exactly. Our first contract we received from last year, July.
Okay.
And this Vedanta is the biggest order we got with a 20 crore value. And since we have already 4 contracts with this credential, we are participating in more than 5-6 big contracts, bigger than Vedanta. So we are very positive that this value will increase substantially in the coming months.
Great. So on the same line, what is the bid pipeline we have currently approximately?
See, I would say we are even participating in large value orders, worth even 60 crore per annum. So the bid pipeline is it's quite high, more than 200 CR.
Great. And what conversion percentage we see in that?
Can you repeat that again?
So what is the win ratio we see or hit ratio in that we evaluate from our end? It will be more than 50%?
So at least we are expecting 20% from the current pipeline.
Okay, great. And with the new plant coming in and new capacity expansion, what will be the new enhanced capacity? If I missed that in the introductory point, I would like to understand that.
Earlier, we had a capacity of 1,500 tons per month. The new line is also having a capacity of 1,300 tons. But we believe we can reach the peak production capacity of 2,500 tons.
Okay. And what could be the revenue at that peak capacity? Max peak revenue?
Let's say if we are running 2,500 tons per month at peak capacity with the current selling price, it can cross 300 CR. Only the scrapping stage, not including the packing contract.
Perfect. That is independent because it's not related to this capacity, right?
Yeah, right.
Right. Great. And margin profile we would maintain because we have recently enhanced our margin profile in the last quarter. So we hope to maintain that and sustain this margin, or it will improve further with this type of packaging coming more percentage.
In terms of margin, now we are focusing on various allied products. If you look at apart from strapping, the steel manufacturers also use a lot of plastics, corrosion protection, chemicals, even tonnage bag, the latching strap, a lot of other things they use for packing apart from steel strapping. So we started dealing these products also recently. So margin-wise, these products are slightly better than steel strapping. So wherever possible, we are trying to add a better value-added products in our portfolio.
Super. Got it. So hopefully this margin would sustain.
Yeah.
These are my initial questions. I will join back in queue for further questions follow-up.
Thank you very much.
Thank you. The next question is from the line of CA Varun Agarwal, an individual investor. Please go ahead.
Thanks for the opportunity and congratulations for a good set of numbers.
Thank you, Mr. Varun. Very good morning.
Good morning. So I was talking to a couple of manufacturers of TMT. They were giving me feedback that when they are buying any strapping, they are not very particular about any brand as long as the quality remains good. So how will we maintain customer stickiness and expect the same customers to buy from us?
Mr. Varun, if you look at this TMT sector, and we are actually doing a lot of branding. All the TMT seeds, we are giving logo printed seed. And mostly the primary manufacturers, my competitor, the biggest competitor, they don't offer colored scrapping, but we are offering various colors. We are very strong in the south market. Tamil Nadu, Kerala, Karnataka, there are a lot of secondary TMT manufacturers where we are giving a custom branded scrap and seeds with the branded. So this kind of facility, only 2 people are having in India. So this customer either have to buy from, out of these 2 manufacturers. And I think you are referring the secondary TMT market in Raipur and Jalna. So those players, they don't bother about the too much branding. But yeah, we are strong in this other area where the people are give a lot of value addition to the branding.
Understand. Hello?
Yeah, yes.
Yes. Okay, I understand. And let's say going forward, if the steel prices start going down, in that particular case, our margins will be dependent as a percentage of the steel prices. So in absolute terms, will our profits go down if the steel prices fall in the future?
See, how we work is, we have a fixed component and variable component in the pricing. Fixed component comprises our value addition, like production cost, salary, and everything, and our margin. This is the fixed component. So whatever is the steel price increase or decrease month on month or quarter on quarter, we pass on that increase or decrease in the steel price. So our margin is it's an absolute value. It's not the percentage of the sale.
So you mean to say if the steel prices go down with a lag of 1 month or 2 months, whatever, our margins will more or less will remain the same?
Yeah, the margin component is same. Even we are doing a lot of long-term orders. Okay, in that there is a clearly defined price variation class. The price variation class is whatever the quarter-on-quarter price increase or decrease in steel prices, that is get added or reduced in the PO price. But our margin component is already fixed in the PO price. Only the price increase and decrease we are passing on in the current running market price. So our profit margin doesn't go down as a percentage of the steel value.
Okay, as per the weight, you must be having an absolute profit then, fixed profit.
Yeah.
At this much ton, this is the profit.
Right.
Okay, got it. And you're planning to expand to Middle East. So is there a competition with the Chinese manufacturers there already, or is there a risk of Chinese getting starting their manufacturing facilities there along with us?
See, you are right. Chinese pricing is always lower than, the basic raw material is lower than Indian domestic pricing. That is a concern for everyone. But we have a FTA with UAE. So we have this 5% duty benefit. There's a TIPA benefit. People, if they buy from India, they can get a 5% benefit. So that is one added advantage. And moreover, we have a local presence in the Middle East. Any customer who is buying from Krishca, we go visit them month on month, understand the requirements, and we are also supplying a lot of other items like CP, LDP, energy bag. So we are in the Middle East, we are trying to be a total packaging solution provider. Whereas in the case of Chinese or Korean, they just supply and they'll forget. There is no local presence currently. And even if they do, they can only do field staffing. Whereas we are tied up with the service engineers, we are offering the free service of the tools. So we are giving end-to-end solution for the packing of the product.
Okay, I understand that we are providing a holistic service. My question was, suppose we are setting up a unit in the Middle East, and let's say Chinese are also setting up a unit in the same area, will their cost of production and sale will be lower than us?
No way. See, because when we put a plant in Middle East, we can also buy from China or Korea or India, wherever the pricing is cheaper, we can also buy the raw material.
Okay.
Currently, the limitation is we are mostly buying from India. Yeah, we'll be at par with any manufacturer in that region.
Okay. And as the end user industry in our business is cyclical, if they go through a down cycle of a couple of years, so our business also will be equally impacted, right?
If the steel production of the entire country goes down, definitely our sales also will go down.
Right. Okay, that's what I wanted to know. Thank you so much and all the best.
Thank you, Varun. Bye.
Thank you. The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, am I audible, sir?
Yes, sir, you're audible.
Okay.
Please proceed.
Thank you very much, sir, for this opportunity. Just first up, I just wanted to understand in terms of peak revenue that you mentioned was from steel strapping, right? And I think we have got 110 million steel capacity also. So what would be the peak revenue from that particular capacity?
See, hi Deepak. Regarding the steel, there are various kinds of steel. Starting from 50 paisa per number to up to 5 rupees per number. So it is difficult to quantify. But I can say the installed capacity with the average selling price would be about the value would be about 15 to 20 CR per annum.
15 to 20 CR. So
Yeah.
that makes it maybe 320 would be your peak capacity from your current expanded capacity, right?
Right, that's right.
Peak revenue. And by when we are targeting to reach our peak utilization level? I mean, would this be this year or next 2-3 years?
So within next 4 years, we can expect the peak utilization in the strapping line.
So around in around 4 years, right?
Yes.
Okay. And in your opening speech, I think you mentioned that we are confident to continue the momentum going forward. I mean, so ideally, the type of growth that we have seen in this year, around 45% top line growth, that is what we might look at over next 2 to 4 years in terms of CAGR.
So, see, in terms of this year growth, we are very confident. At least we will do minimum 25% this year, and this trend will continue for the next 5-6 years. At least 25% year on year will do.
This year and as well as FY'26 as well, right? That's what you mentioned? Okay.
Yes, that's right.
Minimum 25% growth is what we might look at. And in terms of spread that you mentioned on the margin, the component is fixed. So ideally, in a low steel price environment, ideally your margins would be higher, and in a higher steel price environment, your margins would be lower, right? Is
that's
my
right.
understanding?
You are right. Yeah, that is there.
That is there. And our current order book, you mentioned, I missed that figure. If you can just reiterate that, was it close to 110 crores?
No, see, the current order book is around 28.8 crores.
28 crores, out of which around 20 crores is from Vedanta only.
That's right.
Okay, and generally, what would the timeline of this execution?
It is with Vedanta, we have a 3-year contract. Started from this April. Next 3 years, we are having that order.
Okay, understood. And just to reiterate that we don't take any kind of commodity risk, right? We have a pricing clause, price variation clause in our contract, so we don't have to incur any kind of price volatility in our margins, right?
Yeah.
In terms of commodity.
Yeah, most of the contracts, long-term contracts, are having a price within class. Any contract with a higher steel strapping component is absolutely having the price within class.
Okay, understood. And what was this capex that we had incurred in the new strapping line that we I think commissioned on 13th May that you mentioned?
See, around 16 to 17 CR we are invested in this new strapping line.
16 to 17 CR. Okay,
Yeah.
okay. I think that would be it from my side. All the very best to you. Thank you so much.
Thank you very much.
Thank you. A reminder to all the participants that you may please press star and 1 to ask questions. The next question is from the line of Pratik Kulkarni from Kamaya Kya Wealth Management. Please go ahead.
Yeah. Hello, Mr. Bala.
Hi.
Yeah. So I just wanted to ask you a question about the management has in the past Concall said that we were looking for setting up a plant in Dubai, and we were also looking out for a joint venture partner. So what would be the update on the same?
See, it's not in Dubai. We are generally exploring the entire Middle East for setting up a plant. So we are actively in discussion with some potential partners in the Middle East, in Saudi as well as in UAE. So I think within the next 6 months, we will come up with some kind of announcements regarding our next plan with the Middle East.
Okay. And just to confirm it again, you said that for the peak utilization, we would take 4 years to reach this. I mean, it would be reached within 4 years, right?
Yeah, that's what we are expecting.
Okay.
Peak utilization, again, I'm talking only about the scrapping production. So, but parallelly, we are also looking at various packing contracts. So, packing contracts can give us a very good revenue considering the market size.
Yeah, right. And are we trying to, look for new markets in central or northern India?
So we're already there in North India. In fact, we are supplying in Delhi, Jharkhand, Odisha, West Bengal, even in Rajasthan, Gujarat also we have customers. We are supplying pan-India basis.
Okay. Thank you, sir. That's from my side.
Thank you. Thank you, sir. The next question is from the line of Yashwanti from Cogent Finvest. Please go ahead.
Yeah, thank you. Thank you for the opportunity. And congratulations for a very good set of numbers. It's really amazing to see the company had crossed a milestone of around 100 crore in the revenue and very impressive improvement in the EBITDA margin to 20%. So with this improvement, entry in our packaging contract, expanding our base in the overseas country, so what kind of a next milestone company wanted to achieve and what is the timeline for the same?
Thank you very much. Regarding the expansions, we are also now focusing on US market aggressively. And in Bangladesh, Sri Lanka also, we are actively in discussion with some potential distributors and dealers. And even in Australia, we are in discussion. So we are also looking at various steel mills in Europe also who are importing huge quantity. So we are trying to focus all the large volume buyers around the world, not only in Middle East. So hopefully this year our exports will increase substantially due to our ongoing efforts.
Okay. And so what kind of a revenue we can see maybe 3 years down the line or 5 years down the line?
This year, last year we did an export of around 17 CR. This year I can confidently say we will double this number in terms of exports. But down the line 5 years, we will be maintaining at least 100 crore export sales, including all of the allied products. Yeah.
And what's the domestic growth expected, sir?
The domestic growth, as I said, we are targeting a 25% overall growth this year, including both domestic and export.
Is it possible for you to differentiate the margins on the packaging contract and your traditional business? And in the traditional business, what is your margin on your high tensile steel product and your original steel product, steel scrapping product?
No, can you repeat your question again? Sorry.
I just wanted to understand what is the margin difference between your scrapping product and the packaging, your whatever the contract you have received in the packaging contract. So what is the margin difference between that?
See, from what we've seen with the execution of 4 contracts currently, margins are very similar in the direct sales as well as packing contracts. Since packing contracts are long term and the value also very high, customers generally don't offer a very high margin. So, but we are maintaining the similar margin in both the direct month-on-month sales as well as in packing contracts.
Okay. And sir, any emphasis on the distribution channel, expanding the same?
Yeah.
Okay.
Hello?
Yeah. So what kind of expansion, what are your targets for the current year, or maybe for the next 2 years, for your distribution network?
See, distribution network, we are at least we will appoint distributors in all major countries. In Africa also we are in discussion. So in all continents we will be appointing some big distributors this year.
Okay. And sir, just last 2 questions. How much of the top 10 customers are contributing?
So if you look at last year, top 10 customers contributed to 50, I'm not very sure, 52 to 55 crores, that range.
Okay. Okay. And sir, as we are growing and we are growing at a very good rate, so what are your plans to reward investors?
Sorry, can you say again?
As we are growing, what are your plans to reward investors?
Okay. See, right now I'm not able to comment on this. Definitely we will look at something.
No problem. Wish you all the best and thank you so much for the opportunity.
Thank you very much.
Thank you. You may press star and 1 to ask questions. The next question is from the line of Debashish Niyogi from SD Investments. Please go ahead.
Bala, good afternoon and congratulations for a great set of numbers.
Mr. Deba, very good afternoon. Thank you very much.
Yeah. Bala, my question to you is that if I heard you rightly, what you said to the previous person who asked the question, that we are focusing on 25% top line growth for the next 5 years. Did I hear it correctly?
Yeah, see, this year our top line guidance is around 25%. So we are expecting to maintain this year-on-year basis for the next 5 years.
That's very good news, and that's a very positive thing which you're saying. Now coming to, so top line 25% CAGR will take us, will actually triple our turnover, more than triple our turnover in the next 5 years. My question to you is that we have a core business which is the steel strapping business, and then we have extended the core to packing contracts like other competition in the market. Now this packing contract, you are carefully choosing the what type of and then we have a steel related trading business, right, where you're choosing the products in a way so that the margin doesn't reduce. Is the assumption fair, what I'm saying?
Exactly. Yeah, what you said is exactly correct. Currently, we have 3 verticals internally at Krishca. One is we look at the direct sales of steel strapping, seals and the strapping tools. That was our core business in the last 2-3 years. And recently, packing contracts we started. That is a separate vertical altogether. So there is a separate team looking after this packing contracts. And one more business is primary packaging, we call it, where all the allied products, except steel strapping, all other allied products comes under primary packaging.
So from a long-term perspective, I'm not looking at guidance because it's very difficult to give for a business, but the intention would be to keep the operating margin around this level, 18-19% over long term.
The operating margin, I believe, it will be between 15 to 20%.
Okay.
Because, yeah.
Okay. And though we are very small, Bala, but we have good clientele. Okay, so which is really admirable. Okay, given that we deal with JSW, POSCO, SAIL, Jindal. So my question to you is that in the steel strapping business or the packing contract business, these big companies would have many plants, right?
Yeah.
And
Yes.
when they give a contract, it is for a specific plant, not so there's a scope of growth in that organic vertical within that company to many plants also, right?
Absolutely right, Mr. Deva. See, in JSW Steel, there are more than 15 different locations, and in each and every plant also they have different products, different production lines. So each production line, the packing contract is given to a different guy in some cases. So in JSW Chelem, we are doing a supply contract in the Tamil Nadu JSW Chelem plant. But JSW has in Bellary, a lot of other places also. Now we are also participating in the packing contract for JSW entire locations. So by entering one location, will open up the opportunity for us to participate in all other locations.
Okay, understood. Now, my last question is that you answered to the previous participant that we target to be around 30-35% market share. What would be our current market share now?
See, in terms of steel scrapping, we are having more than 10% market share. But packing contract, we just started. I would say our market share will be less than 5% packing contract, much less than 5%. But put together overall, our long-term aim is to be to capture 30% of the overall market. So we'll be working towards that.
Okay. Thank you, Bala, and all the best to you.
Thank you very much, Mr. Deva. Thank you. Bye.
Thank you. The next question is from the line of Amitabh from Sadhan. Please go ahead.
Hi, good afternoon, Mr. Bala.
Hi, very good afternoon.
Yeah. I have one housekeeping question with respect to your approach towards private versus PSUs in terms of your clientele. So in earlier Concalls, we have spoken about that PSU margins are better. So are we seeing that kind of flow into the conversion in terms of operating profit margin in PSU book versus private sector book? Can you just throw some color on that?
Yeah. Currently, in terms of PSUs, SAIL is the biggest buyer. They have more than, 7-8 plants. We are currently supplying only to the SAIL Chelem plant. That is the smallest plant. Still, the eligibility criteria to supply to the bigger plants in Bokoro, Rourkela, it is very stringent requirements. We are yet to fulfill those requirements. So hopefully this year, we are hoping to enter into at least 2 or 3 big SAIL plants in the west. In the east. But once we do that, we can expect a better margin from PSU. But currently, in terms of order book, our PSU volume is very less.
Okay. And in Visakhapatnam, you have an order, I think.
Yeah, we just got it in the month of May. And one more order also we're expecting from Vizag. So again, we just started entering the Vizag steel. So the thing is, most of even the SAIL plants, the eligibility criteria is very stringent. So we are getting small orders. So, and we are also gaining the eligibility for the bigger contracts.
Okay. So how many people are eligible per se, apart from overall for the bigger size? How many companies are there as a competition?
3 people.
Okay. And they are having the 100%. And this SAIL, this Vizag, which is a lower volume, lower end, is hardly would be high. How much percentage of the overall PSU pie, which you are right now addressing to?
Less than 5%.
Okay. Thank you.
That's all.
Thank you. We'll take the next question from the line of Anirudh Singh from Singh & Associates. Please go ahead. Mr. Singh, I have unmuted your line. Kindly proceed. Sir, the current participant is not answering. Mr. Anirudh, may we request you to kindly rejoin the queue. Participants who wishes to ask questions may press star and 1 now. We'll take the next question from the line of Jatin Kapoor, an individual investor. Please go ahead.
Okay. So I just wanted to know that you have said that we expect a roughly 25% growth in overall business. So can you just categorize in how much we expect from packaging and what percentage we expect from strapping?
Yeah. Hi. Both in the packaging as well as packing contract as well as in strapping, we are expecting minimum 25%. In each and every segment, we are expecting overall growth of 25%. Maybe the exports will increase. In the strapping sales, we have both domestic and exports. Okay. So in exports, we are expecting at least 50% compared to the last year. But in domestic, put together overall, it will be at least 20% in the strapping sales. Packing contracts also, we are expecting the same.
Okay, that's it. Thank you. That's from me.
Yeah. Thank you.
Thank you. The next question is from the line of Anirudh Singh from Singh and Associates. Please go ahead.
Thank you for the opportunity. I'm sorry for the inconvenience earlier. So
no problem.
My first question, how is our emphasis on your distribution channel, and do you have any plan to enhance the same?
Anirudh, currently we are not having any distributors in India. We are mostly directly deal with the people. But time to time, dealers also purchase from us, but we are not having any exclusive dealership to anyone in any region. But in Middle East, we have some distributors. Wherever the small clients, who is buying less than 5-6 lakhs per month, so we route it via our distributors network in Middle East. We have some 3 different distributors for various products. All the big clients we try to deal directly in the overseas market. The similar concept we are trying to implement across all other countries. Like I said, we are exploring actively in Bangladesh, Sri Lanka, Australia, and the US, also in Europe, also in Africa. So all the major clients who are buying at least 30 lakhs worth material, we will try to deal directly. All the smaller clients, we will route them via our distributors. But we will soon add the distributor network in our website. We come to some agreement with the potential people.
Okay, great. So can you tell me who are our top client names, if you can, and what was the total contribution to sales from that top 10 clients?
Yeah, top 10 clients contributing roughly 50% of our revenue currently.
Mm-hmm.
Top clients are mostly the steel plant, like JSW Steel is one of our top clients. And there are some big packing contractors who are also buying large quantity from us. So they are also in the top 10. Even in exports in Saudi and Middle East also, there are some customers who are coming in the top 10 customers.
Okay. So do you have any capex plan for 25 and 26 for financial year 25-26?
We just completed one big capex. The production started a couple of weeks back, and now we have various different expansions plans we are contemplating. Definitely, there will be a further capex this year. In a couple of months, we will come up with the announcement.
Okay. As we can see, your company is growing. So do you have any plans to reward to the investor in the next few years?
Currently, I have not planned anything, but we will definitely see how to do this.
Okay, great. Thank you for answering my questions.
Thank you very much.
Thank you. The next question is from the line of Urvil Patwa, an individual investor. Please go ahead.
Hello, Mr. Bala, and congratulations for the good set of number.
Hello, sir. Thank you very much.
Yeah. Just wanted to ask you in the previous questions you answered regarding the addressing the US and the European market. So, in previous con call also you said regarding this, and your concern regarding the duty imposed by the US government or the European government, and that was the reason you wanted to come up with a plant in the Middle East, right?
Yeah. Yeah. Right.
Yeah.
That's right.
So you have started exploring that thing, but still the plant has not been confirmed. So everything is going to take, I think, 2-3 years down the line.
Yeah.
If you want to at all, if at all you want to address those market, and if you start preparing from now onwards, it will take minimum 2 to 3 years.
Yes. If I produce from another country and supply to US, that may take up to 2 years max. But right now, what we're doing, we started exporting directly from India to US. Despite this anti-dumping duty to 25%, our pricing is still very much attractive to the US buyer compared to the local manufacturer. So even this quarter, we have done almost close to 1 CR exports to US. And these are repeat orders. And we are also...
Europe? You are talking about Europe or US?
In US. Anyway, US.
US. Okay, that's great.
So we strongly believe even in this year, we can do some decent sales to US despite this duty. So by the time once we set up a plant, we'll be having some ready set up customers. We can cater them easily.
Nice to hear this thing from you. And secondly, you said that top line you are targeting at the 25% CAGR over next 4 to 5 years. So what would be your pet CAGR you are expecting?
I think it would be about 300 plus.
In terms of CAGR?
No. Not CAGR, the overall revenue.
Okay. So revenue
currently our CAGR is around 120%. If you look at the past 4 years CAGR, we are having around 120% CAGR in terms of revenue.
Okay. So in terms of profit after tax, what would be the CAGR you are expecting?
It is difficult to comment on that for the next 5 years. But this year we can say we will try to maintain the ongoing percentage.
Okay. This is from my side. Thank you very much, Mr. Pal.
Thank you.
Thank you. The next question is from the line of Chandru, an individual investor. Please go ahead.
Hi, sir. I have a couple of questions. Regarding the new capex line, previously we planned to open in January. After that, in third quarter Concall, you said it February, but finally we opened up in May. So, what is the reasons for that delay?
The major reason is the machinery we were procuring from 3 different suppliers. On important machinery was delayed by more than 3.5 months. That will contribute to the delay. And during installation also, since it's a one-of-a-kind line, it took longer than we expected. Almost more than 1 month, it took more time for installation and trial. So these are the major reasons.
Okay. My second question is regarding to the utilization. So, what is the utilization for the new plant, and in this year, what can we expect on that utilization level?
The new plant, we just started the commercial production. It is not running continuously. It's a new line. So right now, current utilization would be less than 15%. It's been just 1 month, right? So this year, we believe it will reach at least 40% to 50%.
Okay. My last question regarding the Gulf capex. You said in multiple concalls we are exploring the areas and some other things. So, what are the delay factors? Why we can't speed up the process for the new plant in Gulf area? Despite we are talking in multiple calls, we are still making to explore the areas. Just want to know that the reason for that.
See, it's a capex heavy investment. That is one thing. And we just came out of one big capex. We don't want to start another investment without completing that ongoing project. And we are also looking for some kind of strong partnership in that region.
Okay, understood, sir.
And by doing this, by talking with multiple people, we are also getting a better understanding about the market dynamics in that region every day. So, the delay is, I believe, happening for the good reason. We would be doing it a much better way.
Understood, sir. Okay, thank you so much. Okay.
Thank you. Thank you, sir. Ladies and gentlemen, as there are no further questions from the participants, I would now like to hand the conference over to Ms. Vaishnavi Ambukar for closing comments. Over to you, ma'am.
Thank you. On behalf of Kirin Advisors, I welcome you all. I'm thanking you all to joining the conference call of Krishca Strapping Solutions Limited. If you have any queries, you can write us at info@kirinadvisors.com. Once again, thank you everyone for joining the conference call.
Thank you.
Thank you, sir. Thank you, members of the management. Thank you.
Thank you. Thank you.
Thank you very much. Thank you all. Bye.
Thank you, sir. On behalf of Kirin Advisors, that concludes this conference. Thank you for joining us, and you may now disconnect your line.